Hi, my name is Gift Constable, and this is a little pre-lecture on how businesses are valued for the Financial Fluency for Product Leaders class I teach on Maven. Now, quick disclaimer for this, because I'm putting this out for anyone to be able to watch. The class is for folks in the technology product world. They could be product managers, designers, engineers who are aspiring to become product leaders. And it's all about trying to get more financially fluent, hence the title, to become a better product leader. It's not to get so detailed that you could become a CFO or an accountant or an investor, but everything is more on the product lens. But this topic of business valuation is really important. Why? For a product leader, it's important because it's about aligning yourself with your owners and with your board and with your CEO, right? When you're out of alignment, then that's not a pretty place to be as a senior executive. When you're in alignment, things may be going great for your business, they may be going challenging for your business, but either way, if you're in alignment, you can execute effectively and feel confident in what you're doing. So I'm going to share my screen and go through a little bit of a few things on this topic around business valuation, beginning with a few theoretical concepts that I'm going to just touch upon lightly, and then talking more practically about how it's done in the real world. Again, all still at a fairly high level, but I'm going to share my screen and talk through a few concepts. Now, one thing that sort of underpins all of this is that if you've ever wondered why did the board make a particular decision that seems puzzling to you, this thing on this slide that I'm showing right now is really the answer. It's that your CEO and your board are obsessing all the time about how to grow or to protect. It could be either one of those things or both at the same time, the value of the business. Okay. And and so you want to be in alignment as a product leader with how they are thinking about protecting or growing the value of the business, which means you need to know how your work connects to the value of the business. And it's helpful to know how businesses are valued themselves. The second part of the class, which I'm not going to do in this video, is really talking about ownership classes, different kinds of investors, and the implications that has for product leaders. But here we're going to talk about business valuation. And let me, again, as I said, I'm going to begin with some of the sort of high level theoretical stuff. And one concept you should understand in the corporate finance world is that a dollar today is worth more than a dollar tomorrow. Now, this is pretty intuitive to most people. Picture you have a dollar in your hand and you're going to give that dollar to someone else. You no longer can use that dollar, right? It's not in your hand anymore. If they're going to come back to you in a few days, in a year worth of time, you would expect more than that dollar because you haven't been able to use that dollar. We understand this as to, it makes sense to us intuitively. When we put money in a bank account, we expect to get interest on that bank account if it's a savings account. Um, and and so, this concept that having the dollar today is worth more than not having it, and then the flip of that is that if you are giving it, if you're putting it to work in something, you should be getting back more in the future to be worth giving up that dollar that's more valuable today, leads to this concept of present value and net present value that you might have heard of. Now, the present value of something, and here's like a very simple formula, is we'll take a payoff that happens in a year. So let's say that person has come back to you and they're paying you back now. So they're giving you a payoff. The present value is that payoff over a rate of return of some kind. That rate of return, that number can vary dramatically depending on the kind of investment that you're making. But the idea is that you're picking a number to discount back that future payoff to today's dollar should be sort of based on comparable projects and investments that you can do. You wouldn't take, the kind of low risk return that, say, a government bond would deliver, and compare that to what a venture capital backed startup should be delivering, where the rate of return, because it's so risky, should be significantly higher. Which then ties into actually the sort of the next theoretical concept, which is that a safe dollar is worth more than a risky one. Again, right? If you're going to put money to work in a government bond, they're going to be delivering you lower return compared to very, very risky investments, which need to come with a higher rate of return to be worth it, to be worth putting the money in. When you hear this concept of net present value, what that's basically saying is if I take my investment, let's say I invest $1 million, so I'm negative $1 million. I've invested that money, and I'm going to get some payoff. And again, in our really simple formula here, we're going to say we're going to get a payoff in a year, and we're going to discount that back by a rate of return that's sort of expected for this kind of project. Your net present value is what's that worth today. If it's negative, you wouldn't do the project. You want it to be positive. You want, after you've discounted back that future payoff by your rate of return, you want it to be more than the investment that you made. And that gives you your NPV. A lot of technology companies with a lot of risk, it's a lot of growth. We aren't doing this analysis on every single project we do. However, if you were in a really predictable, very stable business, you might do this math. This might be a very, very relevant way of evaluating whether an investment is worth doing. In the software product world, it often isn't, but there's exceptions, definitely. Now, you might have also heard this phrase, discounted cash flow. This is the theoretical underpinning to how businesses are valued. It's not really how a lot of businesses actually are valued in the real world, but this is underpinning the shortcut that people use that I'll tell you about in a second. So basically, what is a DCF? The DCF is saying, what's my present value of this business? What's it worth? And I'm going to take the cash that it's going to deliver me over the next year. I'm going to discount that back. And then the cash from the year after that, I'm going to discount that back. The year after that, and you keep on adding up these years until you get to a point where you're like, okay, at that point, I just need to create a terminal value for all the value it's going to deliver me from that point forward. Right. And that's called the terminal value. And the terminal value, you get this sort of this wonky way of calculating it that I've shared here. You don't need to fully understand this, but the shorthand is you take this free cash flow at this final time period you've set for yourself out in the future. Then you give it a growth rate because you will have future years after that. And you discount it back by the weighted average cost of capital, which is something you could calculate for your business. Minus that growth rate. In the technology space, we often don't use this. This way of valuing businesses becomes very circumspect because our world is much more volatile. A DCF can work for very stable, very predictable businesses. Where there's less predictability, this isn't as secure a way of approaching it. And just by having a higher discount rate because there's more volatility often isn't an effective solution. What ends up happening is that a huge amount goes in the terminal value, and there's a lot of subjectivity that can go into calculating that terminal value. And so this is an iffy way of doing it, but it does sort of underpin what's going on. Let's talk about the real way that most investors are thinking about the value of the business. And it's really, what's this business worth as compared to other ones, right? Companies are valued based on comparables. That's the word that's used. Comparables are companies with similar characteristics, similar rough size, similar industry, similar financial shape. You say, okay, those companies are worth such and such. So it's probably safe to say that if you apply those multiples to me, that this is how much I'm going to be worth. Now, I just use that word multiples. What does multiples mean? There's a few different sort of high-level multiples that are used, and these are ratios that can be applied to financial metrics that your business has. If you're a high-growth, highly profitable business, classic venture capital kind of space where the investors, the owners are very happy for it to lose money to drive growth, the way they're valued is a multiple of revenue. So this company's worth 5 times revenue. That company's worth 10 times revenue. That's what I mean by a multiple of revenue. Well, sometimes that revenue, that number that you use is trailing. So what's the revenue I've earned over the last 12 months? Sometimes it's forward. What's the revenue I think I'm going to deliver? And if I forecasted for the next 12 months, the timeframes can vary, but you get that concept of trailing versus forward. So, a lot of businesses, if you take your average business, it's usually not valued. The most important sort of multiple that's being used is usually not revenue, but technology companies, and especially high growth, unprofitable ones, that revenue multiple becomes really important. Again, because they're intentionally unprofitable, because they're trying to grow. The way most companies, your average sort of private equity backed company is valued is a multiple on EBITDA. EBITDA is if you watched the sort of income statement video that I put up, you'd know what this means. It's earnings before interest, taxes, depreciation, and amortization. And right, and you could have, again, you could be looking at a multiple on trailing EBITDA. How much EBITDA did I earn over the last 12 months or X number of months? And how about forward as well? So so a lot of companies that are trying to be profitable as opposed to intentionally losing money, like a VC-backed business, are going to be valued. The most important thing that investors are talking about, you go talk to a private equity investor, for example, and say, oh, that one's probably worth 7 times EBITDA, or that one's worth 12 times EBITDA. And there's a lot that goes into why one might be 7 and one might be 12. And we're going to talk about that more in the class itself. But the key thing to note is that these multiples are actually the shorthand that investors use. And they sort of begin by asking themselves, are there any public companies that could be rough comparables for me? And I'll see how the market's valuing them. But they're also looking to see within the private space, and they have to do more digging because the financial information is not out there, unlike publicly traded companies where there's stock prices and there's SEC filings and things like that. But they're going to try to gather the data to say, okay, of these other private companies that are similar, they might have, been bought recently or had investment rounds recently. So how are they roughly valued? And I'm going to take those multiples and apply them to the business that I'm looking at today, right? Public companies are a key metric that's also used in addition to the sort of revenue and EBITDA figures is PE multiples. What P stands for price, it's your price per share, and earnings stands for your earnings per share. What's my net income of the business, right? At the bottom of that income statement, I'm divided by the total shares that are outstanding. And so you could take a look at a PE multiple for one publicly traded company and compare it to another and get a sense as to which one's relatively worth more than the other. So PEs that's not used within the private sphere, but it is used more commonly within the public sphere. So actually, let me just quickly pop over to Yahoo Finance because I want to sort of call this out. This is a great place to go. And if you're poking around publicly traded companies and trying to understand how are they valued and why might one be valued one way versus another, I like using Yahoo Finance for this. You could punch in a stock ticker and you go down to statistics and you will get a whole bunch of summary information about what's happened with their revenue, with their EBITDA, their gross profit, et cetera, but also up at the top, their valuation measures. And right now, we could focus, this is for Oracle. I just picked that name out of a hat. We could see what their market cap is. Their market cap is their price per share times the total number of shares that they have. Now, it gets a little wonky in terms of that calculation of shares because there's warrants and options and other things. Some are in the money, some are not. But I'm going to put sort of the details of that calculation aside. But market cap essentially is the stock price times the shares outstanding. There's this term you will see, enterprise value, right? And you'll see it as the multiple down here. We're looking at enterprise value over revenue, enterprise value over EBITDA. What is that term? That term is essentially trying to back out the cash and debt that's in this business to come up with the value of the business regardless of the cash or the debt. The best analogy as to why this happens that I could give you, that was given to me when I was younger, is think about a car. You've got a car. You want to sell this car. Let's say the car is worth $1,000. Right, that's what you think the car is worth when you compare it to other cars. Is roughly you say it's about $1,000. Well, in terms of the money that someone's going to give you for that car, if there was $1,000 of cash in the trunk, someone would give you $2,000 for that car. The car itself is worth $1,000, but there's $1,000. You're not going to get a premium for it. It's just cash, but the $1,000 in that trunk, so they're going to give you $2,000. Let's say, however, that instead of cash in the trunk, the car is coming with the last elements of a loan on the car. And let's say there's $500 still owed on this car. Well, the person buying the car is not going to give you $1,000 because they're going to still owe. Car was only worth $1,000, but they owe $500. So they're going to give you $500, right? Because they've got to pay off that debt. So that's what's happening here. You take the market cap and you add in the debt and you subtract out the cash and you get the enterprise value. That's what that number means, and that's why that number exists. That number gets applied to revenue and EBITDA because those two financial metrics occur before any interest is involved in terms of the numbers, right? If a company has put cash to work and is making interest income, or is like, let's say, that they're getting dividends, or investment they made sold and delivered some a payoff to them, that all happens below the revenue line, and it's pulled out of the EBITDA line as well. And so when you're thinking about that, the number that you want to apply to revenue, where interest on debt that the company's holding or gains from cash that they've put to work are pulled out, you apply in order to have sort of an apples to apples consideration, you apply enterprise value to revenue, enterprise value to EBITDA, because remember, interest has been pulled out. But if you're applying a multiple to net income, what's happening with cash and debt, your interest gains or losses are in net income, and so you actually apply the market cap figure to net income to calculate the earnings per share and the PE multiples and things like that. All right. So PE is essentially pretty similar to just taking your market cap and dividing it by, your market cap with your net income, as opposed to the price per share and the earnings net income of the company divided by the total shares outstanding. Maybe that's a little too detailed, but there you go. The last thing I just want to say on this, and I'm gonna I should actually point out this last point here, that when investors are thinking about valuing a business, they will often take a blend of multiple approaches. They'll say, let me see what they're worth from a trailing perspective on revenue, maybe a forward perspective on revenue, maybe trailing on EBITDA, whatever set that they decide to use. And that might be determined on the data that they can gather. So you work with what you've got as opposed to what you want to have. And they'll blend it. They'll say, I'm going to put, more stock in the trailing revenue, but I'm, maybe I'll have that be worth 70% of the valuation. And for anything that's forward looking, because there's risk involved in their forecasts, maybe I'm going to only weight that by 30% or 10% or whatever it might be. But the sort of the concept is you can actually blend multiple approaches to come up with a sort of call it an average, and say, okay, that's roughly what we think this company is worth. Now, all of this stuff is built on top of public company investors doing DCFs and things like that. But as I said before, much more common. A lot of folks in the venture capital and the private equity world are not doing DCF models, right? They are doing enough transactions, looking at enough businesses, and they've got a sense of deals that are going on around them, that they can basically look at a business, and if they understand the core financial profile of the business and operating and risk profile of the business and the industry that it's in, they could say that one's worth 10 times revenue or 10 times EBITDA or whatever multiple they are using. The key thing to note, though, is that what a business is really worth is what someone's willing to pay for it. It all comes down to supply and demand. Many years ago, when I was an investment banker, we had a well-known late-stage venture-backed kind of PE, private equity fund come to us and say, we own this business. We think it's time to sell. This is a software business in the fintech space. And, not unreasonable amount of revenue, and this wasn't a super early stage startup. But what had happened with this business is they had allowed one really big bank to take over a large percentage of their revenue. They didn't want to turn the money away. They loved having this customer. It was a really big brand to have as a customer. But that customer started to dictate a lot of their product roadmap and a lot of the shape of this business. And what ended up happening is that no one else really wanted to buy this business, because there was a market of one. The only buyer for this business was that bank. They'd sort of become a locked-in vendor to that bank with their software. And that bank knew that there wasn't a lot of competition for this business and lowballed in terms of what they were willing to pay for this business. So it didn't really matter what the theoretical value of the software business was. It didn't matter what you could make up from a DCF perspective. It was worth what that bank and only that bank was willing to pay for it. And I've had other situations where we were able to drive a really competitive process and people were fighting over each other to buy the business, and we were able to sell it for a lot more than we thought the business was worth. Sometimes two or even 3x. Again, this is in my younger days, back when I was an investment banker, buying and selling, helping buy and sell technology companies. So, like anything in life, right? If you got a water bottle like I have here, and I want to say, how much is this water bottle worth? It's only worth anything if someone's willing to buy it from me. Otherwise, at this point in time, it's worthless. And so you want to keep that in mind as well, that valuation is dependent on cyclicality, on how the markets are doing, and really at the end of the day on supply and demand, which is also, so it's there's these fundamental sort of numerical underpinnings to it, but human psychology, how bullish people are feeling, how excited people are, how much competition there is for whatever it is, has a huge role to play as well. All right, so that's the end of this video. We're going to be talking a lot more about ownership classes and how you affect as a product leader, how you affect the value of your business, but wanted to have this sort of foundation in your hands. So thanks for joining me for this video. Hope this was interesting, and I'll see you, for those of you in class, I'll see you in class.